Welcome to a new episode of the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is a podcast that will make you a smarter investor, period. And as always, we're going to have a great episode on tap. And this particular podcast is definitely going to make you a lot smarter. Brian Reuter, co-CEO of Permira in the Yahoo Finance house. Of course, Permira, one of the preeminent private equity firms in the world. It's a company I've been following for many decades. Brian, good to see you. It feels like I'm taking away from like doing your next deal or exit here. So we'll try to keep this moving here.
All right.
So talk to me a little bit about the firm. You know, for those not familiar with the type of work that you do, type of investing you do, maybe you give us like a high level overview.
Yeah, I mean, so Permira, we've been around for 40 years doing this business. So it is a very experienced place to be that I'm proud to be able to co-lead today. What we represent in private equity, we manage like a couple different fund strategies, but really at our core, we're about driving growth at scale. So it's like finding and identifying businesses and products and teams that we think have the capability to compound for very long periods of time, and then back those companies to not just become bigger, but become much better over time. And so we've built a pattern recognition framework. We've built a series of value creation capabilities and teams to be able to help companies achieve those goals, and then reflect that ultimately in fantastic investment returns for our investors. We're kind of co-run between the US and Europe. All of Western Europe and all of North America are the focus markets for us. They're like the biggest, most interesting economies for what we do. And we've got a very deep sector expertise that we prosecute. So technology, consumer, including digital consumer, services, and healthcare, with geographic teams in really every major market in Western Europe and East Coast, West Coast, kind of New York Finance Center, Silicon Valley, USA, to be very deep in the geos, in addition to being led by those sectors.
And 80 companies in the portfolio, or is it more now?
It's about 80 companies, yeah, between our buyout portfolio and our growth portfolio. Buyout is really focusing on control, shared control investing, really to be able to drive transformation of businesses. Growth is high governance, but often not control, but more for a little bit earlier stage in the growth cycle. So about 80 companies across those.
And Permira, a player, early investor in Klarna, Informatica, Ancestry. I mean, I can go on. A lot of big deals. Last year was Squarespace. That was a big take private deal for the company. How do you identify, companies that you may want to bring into the fold?
Yeah, I mean, we're looking first and foremost for fantastic products. And the beautiful thing is that when you're out in the ecosystem talking to companies, as we are every single day, you find products that customers love, and those can be consumers, they can be businesses, and you start pulling those threads, and you can chase when people are real advocates for wonderful products. And a typical origination cycle for us to culminate in a Squarespace style take private transaction is not when Goldman Sachs calls us to say we're auctioning a company. It's like, it's years before that. Yeah. I'm really chased by like a love of a product in a market, and then building a relationship with the team, conducting like some of the most important due diligence you get to do, which is listening to teams about what they think they're going to be able to do, and then watching them perform over a long period of time. And ultimately, sure, the exciting news tends to be when the acquisition happens, but that origination goes like way, way back. And it really ultimately starts with finding really great products in great markets.
There's been such a change, I guess I don't have to tell you this, in how private equity is viewed. I grew up, maybe we're around the same age. Private equity, they come in, they cut expenses, and they let people off. But there's been a change in the past decade, where now the industry is seen as a partner. Am I right in that assessment?
Yeah, I mean, I started in private equity almost 30 years ago, and so I think I'm a bit older than you. But it's the thing that's happened during that time period. I mean, what private equity used to be, and actually kind of the origins of the whole category, was about you sort of find the unloved businesses that you can buy at 7 times EBITDA, and you probably cost optimize them and cut a bunch of costs. And it kind of got this reputation as being, you're firing people in order to create profitability, and then you monetize it. And some of that perception still kind of sits out there, but like what's actually changed, like the bulk of where the really interesting gains in private equity today, and for sure what Permira's strategy is and where we've generated the bulk of our gains, is about backing growing businesses. It's about increasing employment. It's about expanding product suites and categories. And like oftentimes, especially as a private owner, you can see this, and I'm sure you've experienced this yourself with Yahoo's transformation, that like you can do so much more in the private markets than you can do publicly. The public markets are often very impatient for like serious transformation. And if you look, you mentioned Informatica, this is a company we took private a decade ago and put $2 billion of internal R&D spend on effecting a complete cloud pivot, a complete organic cloud pivot today, and capitalize on both the magic of cloud data deployment. This company provides data management software, cloud data management software today. And we built what will be in guidance $1 billion ARR cloud business from zero during that time period. We employed thousands more people in that process. And at the same time, despite putting that investment in, have built a company that's now higher margin than it was when we took it private in 2015. So you can affect these like really significant transformations by actually hiring more people, building more products, backing growth, instead of just going and, gutting and running as what the industry started with.
And of course, for those not familiar, Yahoo is our parent company, is Apollo Global Management. So Brian, what companies are, maybe in the consumer digital space, what's exciting you right now in terms of a business model? What gets you saying, you know what, I may want to buy that company or invest in them?
Yeah, I can talk about stuff we've done recently. So let's talk Europe, we'll talk US. So in Europe, Adevinta was a company that we had invested in originally through our seventh fund, which is kind of one fund ago, and then took private in Permira 8, our current fund. This is the world's largest classifieds platform and really has leading classifieds businesses in Germany, in France, in the Netherlands, and had built this like just giant business, which is just a collection of just fantastic assets, but almost was too big kind of in what it represented. And we saw a great theory for actually deconsolidating and building more independence in terms of the technology stack behind these businesses. So take Mobile, which is part of Adevinta. It's the biggest auto classifieds business in Germany, was being integrated into the same product stack as Le Bon Coin in France, which kind of is a very different kind of set of vertical segments, and like giving more independence to these regional leaders, regional champions, and building a collection of really outstanding businesses as part of that thesis has been a lot of fun. That was a very large transaction. This is kind of, 10 billion plus category of take private, and that business is performing really well. And then as you mentioned in the US, Squarespace, now here's a business that does, website development and hosting. And what we saw together with that founder was really backing a plan to pivot that business really towards AI, and not just, so being able to build a web presence, which is gonna be critical, but having that web presence be something that takes advantage of not just the best design features of what Squarespace has always offered, but be able to enable an AI product offering so that you can have that be automated for you, be able to have AI create a lot of those design structures, really even more out of the box than what Squarespace was before. And so being able to back really an AI vision that we share with a management team and oftentimes a founder is a big part of what we think is really cool in the consumer digital space today.
You mentioned Squarespace and its founder, Klarna, of course, its founder still at the helm there in Sebastian. Why lean into founders? What is it about them that gets you guys excited?
Yeah, it's real. I mean, even at the scale, so our buyout fund, Permira 8, that we're currently investing, it's about 17 billion euros of capital that we're investing behind. So the companies that we'll acquire in this are very big companies. I mean, these are like often like multi-billion dollars of revenue. But 85% of the businesses we've invested in through that fund involve the founders in some way. And that's not something we're targeting. We're not saying like we will only go look for founders. But it's really remarkable, especially as a primarily digital investor. Like even in services and healthcare, we've got a very strong digital bent to the things that we find and we do. And we think that's great because you tend to be on the right side of disruption. Even at that scale, founders are often still very involved with these businesses. They might not control it anymore, but they are oftentimes they're on the board. They might still be running the company. And so 85% of those businesses still involve the founder. It's not a target because we think founders are kind of more suited to us. But in those situations, because we have this growth forward mindset, that invest in product innovation mindset, that our value creation is going to be about driving that growth, that's super appealing to not just management teams, but to founders who really care about where their company lines up and who they want to partner with for the next phase of that journey. Versus what we talked about, which is hey, we think your business could add 10 points to its operating margin by shutting down the following science experiments over there in aisle B.
How are you? I'm always amazed by the due diligence that private equity firms do. It's so nitty gritty. It is right down to the very soul of companies. Like, how big is your team, and how do you uncover some of these opportunities that, for a public company, that existing management team may not have been able to find that or have continued to overlook those things?
Yeah, so we operate, we're managing 85 billion euros of capital kind of on the core. And so like we're sitting over the top of a very large ecosystem of companies. And so when we look at our value creation team is around 25 people kind of direct on our group. That's out of like 180 private equity professionals. So we're a very large economic organization, but we're a tight team in terms of the size of the group that's able to drive that. So 25 people can have a very big impact around that. And our philosophy is we want people in there that are real operators who come from incredibly experienced backgrounds with a very verticalized focus of where they have expertise. So like somebody who's coming in who's on the digital side, like an amazing SEO, SEM expert in terms of knowing how to do digital marketing and kind of digital customer acquisition. On the software side is somebody who really understands, Salesforce reorganization on a big software company, which tends to be a big area of value tuning that you can do with these companies. And our goal is when you can show up at any one of those companies that we invest in, even if it's a company that's worth $2, $3, $5 billion, the person we're showing up with from the value creation side, the CEO, we want that CEO to say, this person's better than somebody that I could hire. They're coming from a background that's like more experience than kind of I deserve with my company at the scale that it is. And therefore they welcome kind of the value creation efforts that we're able to come in to help transform those companies. And so with 25 people, you can have a very big impact on that transformation. So then you've got teaming up with our management team, you drive that transformation where like all of the work's being done kind of at the company. We think it's really important that the company builds its own muscle, but helping to steer with like really good guidance and advice and a lot of pattern recognition and playbooks that's coming from us together with our value creation team.
I love that name, value creating team. I mean, that's just you wake up every day like, okay, I'm on the value creating team. I need to get something productive done today.
And what value did I create today?
Yeah, no, that's good. Hang with us, Brian. We're gonna go off for a quick break. We'll be right back on Opening Bid.
All right.
All right, welcome back to Opening Bid here at the NASDAQ in Times Square. Having a great convo with Brian Reuter, co-CEO of Permira, one of the world's preeminent private equity firms. Brian, I've got a lot of stats recently. I'm sure you're reading a lot of the things that are being written about the state of the private equity industry right now, given all going on in the world. This stat has blown me away, and it came to me from Bain. PE firms are sitting on a record 29,000 companies worth $3.6 trillion, half of which they have owned for 5 years or more. What is going on?
Well, you're seeing across the whole industry this extension in duration of how long companies are being held. And it's very interesting. One of the biggest drivers of the AUM, the assets under management of private equity, has been that single factor, that this extension of like the length and time that companies are being held. So deployment's keeping pace, kind of new acquisitions going into these portfolios is keeping it a pretty steady, has been escalating pace. But because companies are being held longer, you have like the assets being managed expanding. And a lot of that has been, like in our case, like we love that we're having businesses that will own for 5, 6, in some cases. Genesis is a big, phenomenal software company. We've invested in that company in 2012, kind of close, February 2012, and we've been invested in them for the entirety of the duration of that time. And so we found that when you have really great compounders, you can actually invest in and hold them for a much longer period of time, and that's great for our investors. But it does create this, escalating scale of AUM in the industry.
But does the traditional 5-year holding horizon for private equity, is that still the benchmark?
I think that's way out of date. So like there's that was all, it's funny, like that has been the standard for a very long period of time. And it's not a bad rubric because most of us will look at the 5-year returns. It's kind of it's a good horizon to think about visibility in, as in like 5 years is enough time to drive some real transformation, like high impact transformation. But also it's not so far out that you're just, throwing darts at the wall about like what's the world going to look like in 8 years. Very hard to like predict beyond year 5 of what the world's going to look like. So that's been a pretty steady horizon for how people look at the initial underwriting of an investment, but things change along the way. And so you get into year 3, year 4 of businesses, and that's when you really get the conviction that you've got an asset that you can really drive compounding returns for an even longer period of time. And those are the ones that you see the horizon extending way out in terms of the hold period. And I should say, like when you look at that versus going back to the public markets, that means that for a lot of these businesses, they're going to stay private longer. They're going to accumulate more value as a private company. and then they may go public. They might get sold to a strategic before they even hit the public markets. But a lot of that equity value growth versus past, let's say, technology waves or just kind of private equity waves is happening in that private market because of that. The big winners will stay private longer.
Brian, is there a hunger within the the portfolio companies and the leaders that you have access to? Is there still that level of excitement about going public at some point?
Yeah, I mean, going public, especially in the digital world, remains this North Star. Like it's the pinnacle of the mountain of your corporate life. And that remains, although I think there is a lot more realism we find in the private markets and kind of the later stage growth companies of just how burdensome it is to be a public company. And that's both, it's the regulatory disclosure requirements, it's really a shareholder base that can be very impatient. I mean, despite the reputation of private investors of being very, detail oriented and kind of in your face, it's very hard to achieve the kind of transformations that we can achieve in the private market with the public market because they just won't tolerate a management team coming in and saying, you know what, we've decided we need to make a cloud pivot and we need to take
there goes that stock. There goes that stock price. I mean, it's going right down.
Gone. And by the way, the cloud pivot will never happen because the stock price will crater. An activist will come in. They'll say this management team doesn't know what they're doing. This business should be generating more earnings today, not tomorrow. And that management team is gone for having suggested something that's really the right long-term value-creating approach for that business. So we think kind of teams get it. So like a lot of times when we're finding private companies that really would like to stay private longer and wait to access or really kind of avoid completely the public market, that's a lot of the source of where we're finding assets to back and invest behind. And then similarly, sometimes you have public companies that just, fell out of favor for some of the reasons that I just described. They might be Ancestry.com. We took private. This company, who many of your viewers probably are subscribers to, it was a very poorly understood public company, and in part because of their market. They had this wonderful TV show called Who Do You Think You Are? The market sort of treated it like it was the TV show owned by Ancestry, which it was not. And despite that, had this incredible subscriber base, was growing revenues at 25% per year, and we took them private at 8 times earnings, and we're able to grow that business very successfully with that management team. We kind of pushed and built the DNA offering, which became an amazing driver of new subscriptions and revenue in its own right, and then ultimately monetize that in the private markets where it remains today, and now having been owned by 3 private equity firms very happily since that take private. So like getting kind of the right companies out of the public markets is a really kind of good thing for us. Keeping companies private has been a really good thing for us. And then look, occasionally taking the right businesses that have the right cleanliness of story out into the IPO market and letting them thrive there. Clearwater Analytics, amazing software company that we invested in about 4 years ago, now public, trading really well, performing it's a wonderful public company. It's a great story for that, behind a great management team. So sometimes we'll absolutely take the right businesses out public.
Is it hard to raise money right now?
In the LP world? Yeah, I mean, so limited partners, who are the ones who are kind enough to give us capital to invest on their behalf. They've had a couple challenges that they've been dealing with in the institutional market. Some of it is a factor of what you had just described, which is we've going through a couple of years of record low distributions relative to the value of assets that are in the ground. I'd say on Permira side, we've delivered a lot of liquidity to our investors, so I believe they're very happy with us on the distribution side. Informatica, which will be multiple billions of dollars to our investors in that single transaction when that closes, being just the latest example of that. But in general, the industry has seen fewer distributions, a very hard selling environment across the board for the industry, and so LPs are seeing less returns, less cash coming in that they could then commit on the way out. And then at least until recently, you had kind of declining market conditions and a denominator, the so-called denominator problem, that they were looking at how much alternatives they had relative to their total asset base. And when stocks go down in the public market and the private portfolios tend not to revalue very quickly, you suddenly look over allocated to alternatives. And that makes for tricky conversations sometimes with your CIOs, because most institutions have ramped their alternatives program. It's part of why we think actually we and others, like we think the wealth market is actually a very interesting place to go. For us, that's actually not a attempt to grow capital or our base, but diversify our capital sources. And by tapping into the higher net worth community of people who kind of appropriate private investors into the kind of funds that we have, is an interesting place to go, because those individuals tend to have very low exposure to alternatives like private equity and what we do, which has generally outperformed really all the other equity benchmarks for a very long period of time.
Before we let you go, Brian, we'd love to get your take on this one. So we've had two opposing views on private equity. You have Blackstone founder Stephen Schwartzman touting his asset light model, no insurance liabilities. You have Apollo, of course, Yahoo's parent company, insurance operation, KKR insurance operation. You get that steady stream of income. You can invest in more businesses. Is there a right and wrong model here for the future of private equity?
There's going to continue to be an enormous amount of innovation on where capital comes from in private equity. And I think the really interesting part is, when I started in it, you had a few kind of $1 to $2 billion funds, and people were sort of stressed that maybe that was too big, that was too much capital, that the private market was overcapitalized, and it just seems like bonkers. Like the entire industry could fit in one of the mega cap funds today. The entire industry in the late 90s could fit in one mega cap fund today. And so we continue to address like more and more TAM over time, more addressable market over time as the industry has grown. I think we're finally starting to tap into so many sources of new capital that it's going to start to crowd the industry. And the scarce resource is going to be who can do that really interesting entrepreneurial origination. Capital is not a problem in total anymore. It's really about who's got the captured kind of market and kind of real differentiation to be able to find and acquire assets in really interesting ways. So we are sticking with kind of we're more on the stick with your knitting with your really valuable institutional LPs as a core, and then expand prudently into the wealth and kind of private market, kind of private individual market, a little bit more that way, but in a way that's highly aligned with that like core institutional base of investors. And that's plenty of capital that we need kind of in this world to really kind of invest behind that really great origination machine that we hold so dear.
All right, fair enough. Solid answer there, sir. Enjoy following all your work there at Permira. Brian Reuter, co-CEO of Permira. Look forward to talking to you soon.
Thanks, Brian.
All right, and that's it for the latest episode of Opening Bid. Continue to hit us with all those hearts and thumbs up on all the podcast platforms, YouTube, and really anywhere else you may discover this thing. We'll talk to you soon.